Hello, everybody, and welcome to HCM's April update. With me today are Dan Rinck and Doug Johnson. You know them from previous webinars. Dan is an investment analyst here with HCM, and Doug is in charge of the investment group pretty much across the firm. We want to get going in a hurry, but one of the things I want to point out is if you have questions, as usual, we'll go to the bottom of your screen and pick the Q&A button and go ahead and just send your question in, and we will try and tackle those at the end of our comments. So with that, with no further ado, Dan, I believe you're first up. Do you want to lead us off?
Yeah, absolutely. So this past week, definitely a lot more excitement than the rest of this beautiful uptrend we've had. On this chart, you'll see the S&P 500, which is the 500 largest U.S. stocks. And you'll see the almost vertical black line. That is the trend line that we have been following since November. Then also on this chart, something I wanted to point out was this little gray bar. This is something we call a runaway gap. So these happen when there's usually very exuberant investors that sometimes put too much money into the market at one time, chasing something, and cause a little bit of a jump in the market. These runaway gaps in the gray bar end up acting like magnets, trying to pull things back down, either to the upside or the downside. They really try to bring price action back down to the level of the gap so they can rediscover and get back to normal, efficient markets. So what we see here is this trend line is finally broken. It fell almost beautifully exactly into the gap, something that we've been looking at for a little while. And is starting to bounce and starting to find resistance. Today, with the market action today, we were down over 1%. But once we got into the gap, the market started to rally and we started to really find some normal price action. So this gap actually occurred, if you would guess, February 22nd. The main event that day was NVIDIA posting its earnings. So NVIDIA had a big, huge blowout earnings, AI talks, posting a ton of revenue, and that really got a lot of traders and Wall Street very excited, and they pumped a lot of money into it, creating this artificial gap. So that, along with, we had tax day, we had Israel and Iran, and we have rates continuing to skyrocket on some higher than expected inflation numbers, kind of led to us really breaking through this downtrend or breaking through this uptrend and starting to go into that gap. So on the next slide here, we're going to talk about trend lines breaking. So a lot of people, or you probably see 10 articles a year about trend lines breaking and, oh, here comes the recession, here comes the big bear market. Well, that's not always the case. It gets a lot of clicks because if you think your money is really in danger, you're going to click on that article. Trend lines break. It's a healthy part of the market. You have strong uptrends. They end up breaking. Price discovery starts, and then an uptrend may start again. Throughout this cycle since October of 2023 or 2022. You've had quite a few uptrend line that ended up breaking. So in December 2023 or December 2022, you had a 5.9% pullback after a trend break, and then another trend started. After that, you had another trend break, 6.6 pullback. You had a long run all the way up into September 2023. You had a 7.2% pullback. Now we had this great run since October, November that we were happy to participate in. We're finally having that trend break and we're down 5%. So When we're looking at it, a trend line break is not the end of the world. It's definitely something that you pay attention to because that's when new patterns, new trends start to emerge. It definitely gets your attention. You really start paying attention to it, but it's not necessarily, oh, here it is. That was the top. Now the bear market begins. These are normal. This is normal price action. And if we look back through the last couple of years, it's kind of mild. So on the next slide, we're looking at election years. So if we're looking back through history and looking at election years and aggregating them, we're kind of seeing that the April-May time during the final election, the final year of the election cycle is usually pretty weak. So this chart here shows all election years in aggregate in that black line in the bottom. The green line is actually election years in which there's a very, very strong first quarter like we just had. In those instances, throughout all elections through history, when there's been very strong first quarters, April and May tend to be weak. Memorial Day is typically when the potential year-end rally into the election begins. So, we've had a little bit of a pullback. I'd say it's very normal. It's healthy for the market. And if we look back through normal election years, which we're in right now, it's pretty common. So it's definitely something to pay attention to and look at, but you have to realize that it's not that uncommon for us to be having a pullback in an election year at this specific time. And then if we look at the overall breadth and health of the S&P 500, this chart's pretty complex, but I think it does a really good job of breaking it down visually into kind of a red light, green light, yellow light. So when you see that green mountain on the bottom, that means the percentage of stocks over the 50-day and 200-day moving average is higher than the other constituents. So when a large percent of stocks are above their 50 and 200-day moving average, that's a very good sign for the market. Those are very healthy times. The yellow-orange mountain there shows the percentage of stocks that are below their 50-day moving average, but not under their 200-day moving average. So the moving averages are just averaged out numbers, averaged out prices back either 50 days or 200 days. There's also other time frames that are commonly used, and they typically act as support levels. So the 50-day is more of a shorter term support level. The 200-day is typically seen as a full trading year, a pretty strong support level. And then on the red mountain there, that's when you have a large percentage of stocks under both their 50-day and 200-day moving average. So when we're looking at this chart here, green, great. The market is very healthy. Stocks are trending upwards. Orange, there's a little bit of volatility, but not really a big stop sign. And then red, as you see on here through 2022, that's when stocks are really under pressure. So with this last week, through this whole run up, we've had a large mountain of green. I mean, we had, when we still do have about 70% of the stocks in the S&P 500 over their 200-day moving average. But over this last week, you started seeing a lot of stocks give up their 50-day moving average. So at this point, we have 41% of stocks below their 50-day moving average. Again, not at the end of the world. It's more of a shorter term. It's a yellow light. It's something we're paying attention to. But once we start seeing red, we start seeing some of those 200-day moving averages break out or break down below those levels. That's when we would be really concerned. So from a market health perspective, it's still pretty solid. Our supports are holding, but we're definitely in a yellow cautionary area. And again, if we rally off of this sell-off, off through this gap, then that will turn back to green pretty quickly. And then we're going to put 2024 in a perspective. So 2024 has been a pretty calm year. We've had, a very solid uptrend intact. Looking back through history, we have 5.5% drawdown just this past week. And that's really actually pretty mild. So this bar chart goes back to 1980, and it shows those little diamonds. That's the max drawdown that the S&P 500 had in a specific year. The blue bar is the total return for that year. The horizontal green line is the average drawdown for any year since 1980. And I think it's I can't even really read that. It's right around 15%. So
14.2.
14.2. So currently that pullback was 5.5%. There's only been 4 other instances back to 1980 in which that are less than 5.5%. So we do expect in our investing lives that a 10% pullback happens just about every year, sometimes a little bit more, sometimes a little bit less. But if we're looking at 2024 so far, it's been pretty calm, not a lot of volatility. So this is really the first volatility pickup we've seen. We might see a little bit more downside, but it would be perfectly normal if we dropped a little bit more. But what I'm seeing right now is we don't really have to. We have a lot of things on our side telling us that the potential through the end of the year is pretty solid. Now, Doug, when I say it's been pretty calm this year, maybe from a market perspective, but from a headline perspective, there's been a lot going on, huh?
Yeah, I mean, things have certainly picked up, as you mentioned, over the past, week or two, and we've had headlines along the way. But I think the surprising thing, and you highlighted it in the first chart with the uptrend, is the type of uptrend that we've seen over the past 5 months has been really strong. I mean, and you can even take it back to what I guess would be the cycle low in October, and we've rallied close to, I think, 26 or 27% off of that level. That's a big move in a short period of time. So the fact that we're getting a little volatility right now, again, is not a huge deal. I think it's important to understand maybe where it's coming from, and then in a bigger context, I think sometimes, not only clients but even investment professionals have an affinity to jump from one extreme to the other. So, we think everything's great, and then the next thing you know, oh my God, the market's going to crash. When in reality, it doesn't work like that very often. So one of the big topics, obviously, has been the recent turmoil in the Middle East. I've had a few client meetings where we've talked about this, and it's obviously a concern, similar to what we saw with the Russian invasion of Ukraine. And the interesting thing is, if you go back and look at all of the kind of geopolitical events going back to World War II, they really, in the grand scheme of things, don't have a giant effect on the market, with some exceptions. So again, this chart goes all the way back to World War II and lists every major geopolitical event that we've seen and how the market has reacted around there. So I think what's important is when we look at the average time to bottom, so that's basically when the event starts to when the market is done selling off from the event, it's about 16 days. So that's 16 trading days, I believe, too. So that's a little more than 3 weeks. And then the time to recovery, the median time to recovery is 16 days. The average is 112, but that number, I think, is skewed by a few different events. So you've got the Israel-Arab oil embargo from the 70s, which was 1,475 days from the bottom back to the top. So a very long time. You have some longer days in World War II, and then the invasion of Grenada is 304. But if you've looked at most of the events past then, I mean, going back to the Gulf War being the last longest one, most of these events come and go pretty quickly, and the sell-offs are relatively minor. I mean, average number 7.6, and then you've got 1 week 1 month, 3 months, 6 months, 12 months from the bottom, all these numbers are positive. So I think a lot of the volatility that we've seen recently in the equity markets has been attributed to what's going on in the Middle East. When personally, I think that's a little bit misguided. I think if you want to know if that situation is really heating up, pay attention to the oil market. And we haven't seen oil really move significantly. It's actually gone down a little bit. So I think the bigger deal is rates. This chart has the S&P 500 versus the 10-year Treasury. And the last 3 CPI readings, and CPI just measures inflation in a general way, those CPI readings have come in a little bit higher than the market has expected. So the narrative 6 months ago was, okay, inflation's coming down. The Fed is forecasting rate cuts. We're going to stick this soft landing. Everything's going to be great. And the market kind of went and they ran with it pretty hard. You can see here, the 10-year peaked last year, right around the time that the market bottomed. That is not a coincidence. It's very much a cause and effect relationship. So now you're starting to see yields bumping up again as those inflation readings have come up, and investors are questioning whether or not the Fed's timeline is accurate. Not only are they going to be able to cut rates, but could we see another rate hike actually in the future if inflation doesn't come down? And the market seems to get indigestion right around this, anything above this 4.4 level. So here, first time we got above it, the sell-off intensified and we went down. Again, picked up, this is the S&P going pretty well all up until we got through this 4.4 level and we've accelerated. I think, as I'm speaking, the 10-year Treasury is trading around right at about 4.7-ish. So when we think about what's causing volatility, I really think that the market's having trouble digesting the fact that rates are moving back up and approaching that 5% level. If inflation numbers continue to come in higher than expected, this purple line could continue to trend higher, and we could definitely see it affect the market. Now, there's other things going on right now. You're right in the middle of earnings season. This is the busiest week, so I think we'll have a clearer picture on what that looks like here in the next few days. But I think for now, rates are the main thing that's driving that indigestion in equities. So, even if we do have a sell-off, where does that leave us? So, each sell-off kind of has its own characteristics, and there's certain markers and what I call them road signs along the way for us to be able to interpret, okay, this is, your run-of-the-mill correction. And when we see those, they're more rebalancing / buying opportunities than anything else. But sometimes they do, sometimes these corrections do contain things that would indicate that there's more to it, and maybe a more defensive posture is needed. We haven't seen that yet, but that certainly doesn't mean that we can't. But this is an interesting chart that I pulled up the other day, and it shows the S&P 500 performance after a 5-month winning streak, and then in the 6th month you have a negative month. Now, we still have a couple days left in this month, so this isn't full yet for this cycle, but April certainly is trending with the possibility that we would have a negative month. But you have almost 30 instances of this happening going back to 1950. And if you look at the month after, quarter after, 6 months after, year after, the instances of positive versus negative markets very much skew in the positive. And then again, the average 1 month out is right around 2%, quarter out is around 4%, 6 month out is close to 9%, and the full year after that is close to 10%. So the track record on this type of movement has been very positive throughout history. So even if we do have a little period of consolidation or a sell-off, it's not the end of the world, and it doesn't mean that, quote unquote, the market is going to crash overnight. In fact, that's very rare. And if we look at the anatomy of stock index declines going back to the Great Depression, you can see here that there's been 329 instances of a 5% or more dip, we'll call that. 103% or 103 times of a 10% or more correction, 47 times of 15%, 27 of the dreaded bear market. Now, there's only probably 2 times that I can remember in history, we'll take the Great Depression out of it, that we had you literally, go to bed one night and then you wake up the next morning and the market's down, 10, 15, 20%. That is the Black Monday, 1987, where the market was halted. I believe it was down close to 25% in a single day. You had COVID, where the market was down 33%, I believe, over the course of 33 days. And then there was some instances in 2008 where you had some big daily declines, but that peak to trough took much longer, almost 18 months. So the ability to navigate something more significant, there's time to handle that if needed. But the point is, those bear markets and big drawdowns usually need to be accompanied by something significant along with it, being a recession, a significant increase in unemployment rate, a huge drop in earnings, some kind of exogenous shock to the system, so to speak. And we haven't gotten there yet. But the mean occurrences of these 5%, you see that about 3.5 times a year on average, 10%, right around once a year. When's the last time we had a 10% correction? July of last year. Most people have probably forgotten about that already, because it seems like it never happened with the rally that we saw. But not only you saw that in July, but you saw that in the beginning of last year where it was close to 10%. 15% correction about once every 2 years. And then the dreaded bear market, I'd say once every 3.5 years. And don't forget, we just had a bear market in 2022, drawdown of close to 28% in the S&P at max. So, the idea that we're going to go from one extreme to the other, I think sometimes is a little misguided. And it's certainly okay to have some type of volatility in the market. And it's not necessarily a great thing for the market to go straight up to the right. It feels good, but it's not necessarily healthy for the market to do that. So you hear a lot about stay the course, but this is a chart that I think backs this up. So the ability to stay invested, close to your neutral target, whatever that might be, and to keep a majority of your risk in equities if you're so inclined to do so. Because here's the S&P's total returns, again, going back to 1928, this line is skewed to the right, meaning that more often than not, the market is going up. There are years, obviously, that's not the case, but the percent of years with positive returns for the S&P, 72.9%. So roughly 3 out of every 4 years that the S&P is going up back to 1928. So we like those odds. So certainly not saying we can't see volatility, certainly not saying that we wouldn't adjust equities if we felt like things were, moving in a direction that we didn't like, or we saw things that gave us concern. But for the most part, we want clients to remember that this is a long-term game, not necessarily a short one. So with that said, Mike, I would say that probably one of the most hated things over the past 2.5 years is bonds. So what can you tell us to make us not hate bonds so much?
Well, probably nothing, I suppose. But we can talk about why they're important.
Okay.
So, there have been books written about what do women really want. There are books written on what men really want. And there have been surveys done about what retirees really want and what worries retirees the most. And the thing that worries retirees the most, according to surveys, a recent one I saw from CNBC, is running out of money. I'm going to paraphrase it a bit, but running out of income to spend on the things that they want to spend their money on. And I will say that going back to the beginning of HCM, the thing that the problem that we were trying to solve is how to create a reliable stream of income regardless of what the markets were going to do. So the next slide begins to talk about what we refer to as an income safety net. And the safety net basically is a system that incorporates bond ladders, which we're going to talk a little bit more about in a minute. But it's a system that has a number of qualities or priorities built into it. So even though, as Doug has just mentioned, the chances of the big one lurking around just over the horizon is slim, it's not zero. And so from our perspective, we always want to be prepared, because it's not a question of if another bear market will happen. It is a question of when. And to the extent that we know it's coming, that gives us the opportunity to be prepared, not unlike the commercials that want to sell you food to keep in your bunker. So when bad things happen, you're in good shape. We're not going quite there. But when we build a portfolio, one of the first things we talk to clients about is what their income needs are, what their planned cash flow requirements are going to be. And those of you who have been with us for a long, long time will remember the mantra that financial independence requires income that's in cash, dependable, diversified, and growing faster than inflation. You see, that's the first 4 points on this slide. Money comes in cash in our program primarily by growing dividends, interest, and the maturity of fixed income bonds that are investment grade, high quality, and we know exactly when they're going to come due. It needs to be dependable regardless of market activity, because people don't want to have to adjust their standard of living based on, again, the ups and downs in the market, especially when we know they're coming. We just don't know when. Portfolios are always diversified. The diversification is a way of reducing overall volatility. That volatility is important. We'll talk about that in a minute. And the big one for us particularly is growing faster than inflation. So the issue here is that you can go to the bank and buy a certificate of deposit. You can go to an insurance company and buy an annuity and get a straight payout. But as time goes on, the payout is fixed and the cost of living keeps going higher. We know we know from the spike in inflation that we recently had just over the last couple of years that inflation really can come on quickly. Over the course of just a couple of years, inflation ran, depending on the measures you use to measure it, around between 10 and 12%. During that period of time, the dividend growth portfolio, the dividend streams grew about 16%. So the idea is, how do we stay ahead of it, and incorporating these things is important. Another issue to think of, if you can just go back quickly, Doug. The last 2 points there: protecting against unplanned drawdowns and supporting legacy. So when we were putting this together, we used Social Security as sort of a model, because Social Security is essentially considered sort of the gold standard for retirement income, but we wanted to improve on that. Okay, now we can roll the slide. And the idea of improving on Social Security was to recognize, what does it have that's good? Well, it has no credit risk. Government prints the money. You can't outlive it, so there's no longevity risk. Social Security provides inflation adjustments every year, so inflation won't get you. It's paid in cash, so there's no liquidity risk, and you can't spend it down. It means you can't deplete the fund. However, that has a plus and a minus to it, because you don't have access to the funds. If you think about it, you've worked your entire life. You've effectively built up this large balance with Social Security, but you have no way of accessing it. So when we looked at building the safety net, we wanted to build on those good points and work around the weaker points. Inefficient it's relatively efficient in taxation, in that when you collect it, not all of it is taxable, but the portion that is taxable at ordinary income rates, so that can be improved on. We talked about the fact that there's no legacy protection, especially for someone who dies relatively young. For example, let's say they start Social Security at age 67, 68, something like that, pass away before they're 70, all of that benefit is lost. So their family achieves nothing. So that's a real hurdle to get over. And political risk. Obviously, there's always the threat that the benefits could be adjusted, especially for wealthier individuals. In 2033, the Social Security system is scheduled to effectively be bankrupt, which may well push politicians into additional adjustments, whether they change that by reducing benefits for wealthier people, they do it by raising the amount that's taxed. There's lots of ways to skin that cat, but we wanted to set those issues aside to the extent that we could. And the most important element of this whole program is to buffer volatility, something in the trade that's known as sequence risk. So, Doug, you can go ahead and move that along. Sequence risk basically recognizes that the volatility of returns does have an impact on the outcome in a retirement-oriented portfolio. If we were going to play the game, are you smarter than a fifth grader? You might draw the conclusion that it doesn't. In the fifth grade, we all learned something called the commutative property, which basically said when you line things up in a row and multiply them times one another, regardless of the order of the elements of the equation, the factors in the equation, the answer doesn't change. Well, that works with addition and multiplication. It doesn't work with subtraction, division, or retirement planning. So you see on the right side of this slide two potential streams of returns. In column one, a 20% loss in the first year, in the second column, a 20% gain. All we did was invert these numbers. It's the exact same stream of returns. And in fact, if you put $1 million in a portfolio and got either of these columns of returns, when you got to the end, you would have about $1.4 million. However, when you look at our retiree, most people are familiar with the 4% rule. So in this case, we started with $1 million and we took out $40,000 a year. And depending on which sequence of returns you get, we have almost $250,000 different. It looks like about $230,000 difference in balances in the two sets of numbers. And so when we get to year 10, because every day is sort of like the beginning day of a new retirement, in one case, you're starting with almost $1 million. And in the second case, you're starting with only $760,000. This is the consequence of sequence risk. And obviously, the 760 would support a much smaller retirement income from that point forward than the roughly $1 million you would have if you were lucky enough to get the good stream of returns. So now introduce the concept of the bond ladder. So how does the ladder work? The ladder essentially, if we go to the bottom of this slide, effectively, the best way to do this is to begin this process 3 to 5 years before retirement, so that you sort of take the interest rate risk out of putting it all together in 1 year. As we have seen in the last several years, interest rates can fluctuate wildly, and we want to be able to capture the higher rates when we're putting this together. So in this case, in year one, we buy a fixed income maturity investment, and we buy that in 2023. In year two, and that's going to go out for 3 years. In year two, we buy it again in 2024. Now we're holding 2 securities. In year three, we're holding 3 securities, and then these continue to roll over. They mature, and we buy the next one, unless we're in a rocky market, in which case it would have matured at full face value, no loss at all, and we could use that money, if necessary, to support our living needs. So if we can move on to the next slide. this is what effectively what a bond ladder does when you see it visually. The sort of bluish lines in the center, bluish line, the reddish lines are using two different fixed income product groups, one from Invesco and another from iShares. Both are basically the same thing, building a 3-year ladder. And the orange line is what happened to the bond market. So you can see that what effectively has happened is we've taken all of the volatility out of the bond market by having these shorter term things that just simply roll over that create available cash flow for us. And as you saw earlier in some of the comments that Doug and Dan made, you see what the bond market plunges when interest rates rise. And we obviously don't want to be exposed to that type of volatility with the money that we want to be able to spend. So that's the shorter term money. So if we can go on to the next slide. This is sort of just a pictorial example of how this all comes together. So if you think about a portfolio, it has stocks, it has bonds, it has cash in it. The longer part of the portfolio generates dividends, it generates interest, and it generates capital gains over time. So if we think of that as being a bucket that then pours those cash items and the realized gains downstream, we get this waterfall effect. So what's happening is we're going from the most aggressive, most volatile assets into the middle bucket and then into the lower bucket. And the lower bucket is the one that includes the bond ladder. So that would have, in the example we just looked at, those fixed maturities, and they either get reinvested, as we saw in the example, or if we're doing it in one of those dreaded bear markets, then we have the cash flow coming due at full face value, and we can tap that off and use that to meet our spending plans. One more slide. And this shows how the bond ladder works within the safety net in an operational perspective. So in this example, if we assume that an individual needs $100,000 a year to meet their living needs, and that their annual cash flow is $75,000, so that's going to come from things like interest, dividends, Social Security, pension, if there is one. And so we need 100, we have 75, we've got a shortfall of $25,000. You can kind of see down on the right side that $25,000 gets stacked up in maturities coming due in 1 year, 2 year, 3 years, 4 years, and 5 years. That straight line that's running across the screen up and to the right, that shows what the financial independence target return would be. So everybody's plan has a number that they need to make in order to make the plan work. And the sort of wavy line is life happening. So there will be periods where the returns are higher than is needed to make the plan work. In the example we showed a minute ago, that top bucket is going to fill up with gains, interest, and dividends, and they will fill downstream to fill up the bond ladder. Then there are going to be times when the dreaded bear market comes and the returns are going to be below that line. When that happens, we have plenty of money. We still have $75,000 of cash flow being paid into the portfolio every year. And then we go back to the that lowest bucket where the bond ladder is set, and we have securities maturing at full face value that are not incurring any loss whatsoever. They come over to feed the deficit. And the reason that this is a 3 to 5 year window, as Doug mentioned earlier, is that there's a period of time when the markets are depressed and then they go through a recovery phase. This is the window that it takes for the business cycle to sort of operate, and historically anyway, get markets back to where they were so that we're in full recovery mode and the bond ladder is refunded. And this essentially then becomes a perpetual motion machine. That does it for these remarks. Doug, I think you have some great predictions for us. Understand.
Yeah, no, but thanks. And I think that was, good information on the value of having fixed income in portfolios, even in light of what happened in 2022. A lot of people are saying, bonds are worthless. You don't want to own them. But they certainly hold a place in your portfolio. And I think that was a good explanation. So yes, predictions. So one of the most common questions I get in client meetings, some serious, some joking, are, where do you think the S&P is going to finish at the end of the year? And if you've ever asked me that, you'll hear me gracefully decline to even give you an answer, but more or less explain that, we don't know, and trying to predict something like that is kind of a fool's errand. And I think this slide is just my annual reminder of that in real life. So these two charts on here show predictions for the S&P 500 close approximately 1 year out from most of the, what I'd say, major investment houses on Wall Street. You look to the left, and in December of 2021, now, if you remember back then, the market was close to all-time highs at that point. The 2022 close prediction. So if you just go down, I'm not going to go through all of these, but you see some fives here, and then you see some fours, but you don't see any threes, and you don't hardly see any low fours. We'll give Morgan Stanley some credit. They were the closest. The 2022 close ended up being 38.38 on the S&P 500. There is not a number on here that is close to that. Now, fast forward to the following year, November 2022. So a year after we had a major drawdown, we were just kind of recovering some of it. Everybody was doom and gloom, very dire predictions. So you look at these numbers, they're very different. A lot of threes, some low fours, not even anything in the mid fours here. Okay. 2023 S&P close, 4,769. Again, look through these numbers. Nothing is close to this. So the takeaway from this is, don't get caught up in predictions. You're going to see them from people from time to time. The drastic ones will make the headlines. So I'm sure there's somebody predicting an S&P 6,000 sometime soon. And I'm sure there's somebody predicting an S&P 3,000 sometime soon. And I'm sure they've got a well-written white paper explaining why that's going to happen. But for the most part, it's just an educated guess. And we don't really put any significant stock into what those look like in terms of the way that we decide to manage money. So that's just my annual public service announcement to ignore predictions. And if you ever see me give a prediction with an exact number, you know that I'm just lying. So with that, let's get into some quick Q&A here. So the first question, ironically, this is about something that we talked about earlier. Just recently, there's been some quote unquote outrageous tax proposals from one political party. Does this concern you if for some reason this would get passed in Congress? I think what is being referred to is a proposal by President Biden to institute a 44.8% top level capital gains tax, and then the possibility of an unrealized capital gains tax. So I will give my short answer. Am I concerned about it? Yes. Do I think it will pass? No. Mike, Dan, do you want to expand on that answer at all?
Yeah, I'll jump in. Clients may remember a couple of years ago, about 2 years ago, we were really pushing hard to get estate plan revisions in place because the administration was also pushing hard to make a number of year-end changes that would take away certain trust provisions that would make these that would make death a realization event. It would effectively eliminating step up in basis and those sorts of things. That did not happen. And those, as you're alluding to, are baked into the proposals that we're looking at today. Some of the other more aggressive ones are just having people mark to market their securities at the end of every year and pay tax on unrealized gains. That seems almost unfathomable. I think what's probably happening is the earth is being softened for the end of 2025 when what's referred to as the Trump tax cuts expire, because there will be a number of changes involving a variety of things that will essentially increase both taxes, but it will also increase deductions. The balancing act will again depend on where somebody is in their individual situation and create a lot more in the way of planning opportunities. I think what it does, though, is it highlights the simple fact that as a country, we've written checks we can't cash, and there are a handful of ways to peck away at those deficits. One is to allow inflation to run a bit, because inflation reduces the consequences of the debt. You're repaying debt with cheaper dollars. You can raise taxes and try and raise more money to pay the debt, or you can reduce spending. Everybody has their own views. I'm not going to jump on a political bandwagon one way or another here, but I think regardless of your party affiliation, reducing spending seems to be off the table in any really effective way. And so taxes likely have to go up. We will again be beating the bush with people as we come up at the end of 25 in between now and then on a number of things people can do to protect themselves, much like the bond ladder things we just talked about. We don't know what the results are going to be. We don't know if the markets are going to go up or go down, but we can be prepared in the event that something happens. When I started my comments, I quoted the CNBC survey about retirees being worried about running out of money. I certainly hope HCM clients don't carry that worry with them, because we do so many things to protect people from that. Items that we never really even discussed in the program today. Same with taxes. So coming back to the question, the big stuff, no. Little stuff, yeah, I think it's inevitable, and we can plan for that and hopefully try and stay ahead of it.
Okay. Mike, in your answer, you mentioned estate stuff, so we don't have any more questions, but I know we do have an estate event coming up that you were going to mention.
Right. I wanted to make sure that everybody is aware, and this coming up next week, next Tuesday, April 30th, we are having an in-person event. It's going to be held in Blue Ash. We're having an estate attorney come. Gentleman's name is Jacob Samad. He is going to discuss what it takes to be an executor. So one of the things that we've noticed over the years is people, especially with elderly parents, if something happens to a parent, they get thrust into this role of being an executor of an estate without any warning or any preparation. So anybody who has parents who they think they're likely going to wind up being in charge, and it gets especially problematic if you have siblings who don't get that role. It's a worthy course to sit in on if you think you may be in that situation. So,
not to interrupt, I think Maureen just dropped the link in the chat if people want to sign up.
Perfect. I was just going to say, you should have received an invitation, but if it got lost in your email and you would like another invitation to register, there are still some seats left, and you can give Jackie a call. You can look at the link in the presentation, or give us a call and we'll send it out to you if for whatever reason you don't see it or don't find it. So I think that wraps it up for today then. As usual, I want to make sure that everybody understands that we greatly appreciate everyone's loyalty and confidence in us. If you know somebody who's got retirement in their sights sometime in the next 3 to 5 years, that's when we would begin to build these ladders, even if there's little other preparation going on. So if you know somebody who would benefit from some of the things we do and they'd like to have a conversation, we would appreciate getting connected. There's certainly no strings attached. Until next time, and if something does go crazy, we'll be back early, but until next time, I think that does it.
Thanks, guys.
Thanks, everybody. Bye-bye.